Okay, so that's the backdrop, extremely choppy markets. So how should investors approach it? Traders are having a very bad time. So maybe everyone turns investor at this point in time. Let's invite Navneet Munot, the CIO of SBI Mutual Fund. Good morning, Navneet. Thank you very much for joining us. Can we even say with some confidence that we have seen the worst, but we are going to linger at lower levels for a long time? Or do you think even that 7,900 is not sacred and we could see something lower?
Extraordinary times. I mean, humanity has not seen something like this over the last 100 years, where almost the entire planet is impacted by a virus. I think the last time we have to go back to 1918 and something like that. Obviously, over the next few days, everybody would be watching how the situation is evolving. It's unfortunate and it's very painful that people like you and me, we look at charts of markets and spreads and valuations and various things, even economy and social trends. But today we are looking at the number of people infected and the number of people died. I mean, that's very painful. But that's the reality. And over the next few days, everybody would be keenly watching how the virus is spreading, how the policymakers are able to contain it. And particularly in case of India, I think everybody has been waiting a strong response from our policymakers.
Navneet, hi, good morning. I take your point entirely. Of course, at this point in time, there are larger issues than financial markets. People are concerned about their health at this point. But I want to understand what your view is now on banks, because not just the vulnerable banks like Yes Bank, IndusInd Bank, but now some of the marquee names have started to crash. Hdfc Bank is now down 40% this year already. Does it look like a good time to be deploying some money into these large cap names, or would you want to wait and watch as to how it pans out over the next few weeks?
So yes, if you take a longer term call and believe that this too shall pass over the next few days, few weeks, things would start coming back to normalcy both globally as well as in India, then some of these franchises, they have really become attractive in terms of valuations. As Lata was mentioning a few minutes back, that nobody would have imagined these prices, nobody could have visualized that we are likely to see these prices within a matter of few days. So surely they are attractive from a longer term perspective. At this point in time, the volatility is heightened, unlikely to subside given the global environment. And I repeat the same point I made earlier, that everybody has been waiting for a very strong policy action. What we have seen by the central banks and other policymakers globally, I think we need to do a lot more to ensure that financial system does not create more vulnerability to the rest of the economy. We had some fault lines. I think the overall non-banking sector just started recovering a little bit. Also, because of the rest of the real economy, not only that we were worried about the real estate earlier, but now there are some of the other parts of the economy which would also get negatively impacted. I think a much stronger policy response is needed to ensure that financial system doesn't show any kind of vulnerability.
Okay, Navneet, in that case, since I've said that at least 3-4 times, what's your wish list?
Variety of things. If you watch what most of the other central banks in the world have done, and I think there the policy ammunition was very limited, because this time globally the debt to GDP is at an all-time high and the rates were close to all-time low. But despite that, I think every single thing that was done in 2008 and global financial crisis, and then in the euro crisis of 2012-13, including buying ABS or buying commercial papers or supporting money market funds or providing forbearance to several sectors which are impacted, I think all of those. So starting with a deep rate cut along with huge liquidity injection in the market, trying to support some of the other segments of the market. Today the illiquidity is reaching a level where even the AAA and AA rated bonds, even the commercial papers, they are all likely to get impacted as the risk off continues. I think it's important that we provide support to the market to ensure that the linkages between real economy and the financial economy don't move into a vicious cycle. We have to get into a virtuous cycle. I think if you are able to stabilize the financial system and support the sectors which are impacted by the crisis and people working from home or not traveling or not going for events, I think both of them are very, very critical, apart from addressing the health crisis which is staring at us.
The important flashes on HDFC Bank, this is UBS report which contextualizes the call they held with the HDFC Bank management for investors. I'll just read out 4 points. They say trends in unsecured retail asset quality is stable. 80% of the unsecured loans are to salaried employees. Unsecured loans majorly comprised of good and strong corporates and government employees. SME portfolio of the bank is well diversified geographically and industry-wise, and 70 to 75% of the SME loans are secured. There's a bunch of other stuff as well, and they wrap this up by saying that they maintain a buy price target of 1480. So, this is, Lata, what I was talking about earlier, that people in a way were linking the UBS call to the ADR fall, and I highlighted this right on top, that the ADR fall may have to do with the fall in FII premium. FII premium is nothing but the local price plus 1 year forward premium. And that has come down dramatically. I think that has come down to next to nothing as compared to cash prices. But there is nothing in the UBS, at least in the UBS report, which highlights anything bad or stressful in that particular sense. Navneet,
I would have actually expected that an HDFC analyst call would have actually been encouraging. In fact, exposure to hotels, airlines, everything is under control.
Navneet, any thoughts on this? What we are seeing in the financial space and your assessment?
Now we have this FSDC, Financial Stability and Development Council, consisting of Finance Minister and all the other regulators and the other policymakers. I think we need to revive that, and at least I think several measures within all regulators have to be taken to ensure that India is in an advantageous position rather than getting impacted the way rest of the world is likely to get in terms of getting into a recession.
That's a fair point. I just wanted to tell you that while Prashant was discussing the highlights of that HDFC Bank report, all of which looking positive, so not really justifying the kind of fall we saw, there was another announcement from Hdfc Bank that the CEO has sold some shares, but that is only because he wants to pay off a loan which he had taken for availing of ESOPs. So I think they're just being proactive and announcing that the MD and CEO has sold shares should not be interpreted negatively, because he's actually using that money to avail of the ESOPs, and also an announcement that he intends to sell 35 crore shares. So that's just a proactive announcement that should not be treated as negative. I guess that's what Hdfc Bank is telling us. We will have the management shortly. Navneet, I wanted to ask you basically what is your assessment of the markets itself at this point in time? I know it's a little difficult to draw a line, but do you think sufficient long only funds are now interested? How has been the behavior of retail investors? Have you seen any of them coming in for redemptions or calling off their SIPs in the last few weeks? Would you say that 7,900 at least is a line in the sand?
So the retail investors so far have been quite resilient. In fact, as you know, in February we had record inflows. Over the last few days, there are no signs of panic among the retail investors, but obviously everybody watches the ticker. When people look at the mark-to-market losses, we have to see how they react to it. My sense is that so far, over the last few years, we have witnessed that every time market fell, people were looking at that as an opportunity to enter the market rather than exiting the market, whether the fall in 2016 or post-demor or some of the other occasions in 2018-19. I hope that trend continues. And a related aspect to that, when I mentioned about the policymakers, in the last budget and over the last few months, we all know that there has been excessive reliance on attracting foreign savings, whether the sovereign wealth funds, foreign portfolio investors, multinational companies, etc. But given the global situation, I think we need to focus a lot more on ensuring that domestic savings get channelized into our capital markets. Otherwise, I think we'll have a shortage of risk capital, and to ensure that the adequate risk capital come from the domestic market, if any regulation needs to be revisited or any guidelines need to be revisited, I think we must do that very strongly. On the market, whether it's a send line, I think purely from a valuation perspective, when we look at the trailing earnings and the PE, when we look at the trailing earnings yield versus the bond yield, when we look at the trailing earnings over the last 10 years, which is known as a Schiller PE versus the bond yield, On all these parameters, market is as cheap or cheaper than where we were in 2013 and early 2016. We are not as cheap as for a brief period where we were in 2008-9, but otherwise over the last 10-11 years, this is the cheapest where the market could get. In terms of price to book, we are 1 standard deviation below the long-term mean. So obviously markets are cheap. It's just that, as FDR mentioned during the crisis in the 1930s, we have to fear the fear itself. And I think that's where we are. And I hope that with the right kind of action, there's a possibility that it turns out to be a good moment for India from a long-term perspective. It depends on how all of us rise to the occasion to take advantage of the opportunity which can present itself over the next several quarters and several years.
Yes, sir. First, we have to respond responsibly as citizens, and then, of course, sensibly as investors. I take your point. Navneet, you began by asking with your wish list, but if you can make it a little crisper, do you think giant rate cuts, how much? Loan forbearance, how much? Just one or two key asks so that the financial dislocation doesn't get severe.
So variety of things. I mean, you listed few of them, a rate cut and a forbearance for some of the sectors to ensure that the credit to SME, retail and those sectors which are negatively impacted by the current slowdown, they don't get into a bigger trouble. But apart from that, variety of things, for example, the spreads on even at AAA bonds like NABARD and Exim have gone up. Can these PFI bonds be made part of HQLA for LCR calculation so that banks can buy more? Can we remove SLR and CRR on interbank repo on corporate bonds so that more banks can buy more corporate bonds and can repo? Maybe RBI can provide refinance against AAA rated or at least the PSU bonds to bring down spreads and provide liquidity. What we did in 2008 to open a line for mutual funds to meet redemption just in case there are redemptions, nobody took that line at that point in time, but it sent a very strong positive signals to investors and to the industry. I can list a couple of more. As I mentioned that over the last couple of quarters, whatever we have tightened in terms of regulation as a reaction to the credit crisis post IFS, a lot of things can be revisited in light of what's happening globally and what may happen in India over the next few days, few weeks.
Okay, so Navneet, the two spaces that are doing quite well today, one is FMCG with names like ITC, HUL, Nestle, all up about 2 to 3 odd %. Of course, people are stocking up a lot more right now in preparation for a partial or complete lockdown. And the other space is pharma because of what's happening with the discovery of COVID drugs. So IPCA laboratories, etc., doing quite well. In these two spaces, FMCG and pharma, would you raise allocations now?
So consumers have been doing well for quite some time. There is also a move towards defensive. In fact, we have been seeing it over the last few years. It started changing a little bit in last 2 or 3 months, but again, given the global environment, there is a move towards defensives, and that's where the consumer comes in. As far as pharma is concerned, I think given what's happening globally, I think the spending on pharma globally or healthcare as a sector is going to go up very substantially by all policymakers. The fiscal response will start with a lot more spending on healthcare, followed by some of the other infrastructure, forbearance, etc. So I think pharma over the next several years could be a structural story. I think some of the challenges that were seen from US FDA investigation, etc., that may slow down over the next few months. And I think I call it a Y2K movement for India for some of the industries, and pharma and healthcare could be one of those where I think India can really take advantage of the situation which is undergoing globally. This is one of those movements where several industries will undergo a transformation. There are new forces which will change the fortune of several businesses, several industries, several sectors, and I think some of those, pharma is one among those.
Okay. Well, thank you very much, Navneet. That was a very helpful conversation. Seems to have soothed frayed nerves, but I could be speaking too soon. At the moment, it's only the Nifty Bank which is in the red. Thank you very much for joining us with your wish list, both for the Reserve Bank and for the government. As I was saying, it is the Nifty Bank which is